Welcome to The Gray Report. I'm your host, Spencer Gray, and if you are a multifamily investor, well, this is the podcast and show for you. On The Gray Report, every single week, we're breaking down everything that's going on in the multifamily industry, real estate, and the economy, bringing the latest research reports, data, articles, and opinion, kind of just straight to you so you can make some of the best informed decisions that you can. Lots going on. We've got Jerome Powell right now, just as we speak, is in front of Congress testifying on his views on inflation, where the market's going. A lot of talk about housing, but we also have reports from Berkadia, RealPage, NAR, more, and of course, great opinions from Dr. Matt Bosnagel over here, myself. Let's just get into it, Matt. Let's do it. All right, everybody. Matt, it's great to see you. It's been a little while. Nice to be back. Mm-hmm. How you doing this week?
Pretty well. There's a lot of things have happened this week. A lot of things are looming over the market, but I think we're gonna talk about that.
So, Matt, on the way in this morning, Jerome Powell, he was at Congress testifying in front of the Bank and Finance Committee. A lot of questions. Obviously, people are talking about rate hikes. He doesn't want to say much. One thing that I found interesting is we're always talking about, what Jay Powell, what are the Feds going to say? First question to Jerome Powell from Maxine Waters in regards to inflation, monetary policy, housing.
Yep. Yeah.
Front and center.
I think that it is particularly pressing of an issue if Congress starts taking note. We've seen it. Past few weeks we've covered like kind of the mainstream attention, and it's still not. I don't think it's dominating the airwaves like it could be, but
it's not. But it's a lot more than we've seen in the past. Because like you've said in the past, Matt, people don't always talk about rents are higher now than they used to be. People may say just in general conversation, things are expensive, but now it's like, wow, housing is expensive. What's going on? What's going to change it? And we've talked about rent control. We've talked about supply. The questions that were being directed were more about, what Congress can do to alleviate the problem in terms really of incentivizing more supply, building more affordable housing.
Well, why can't they just force people to build and put them in jail if they don't build?
Exactly. And I think we've probably tried that. But just some things of note. There's 7 million rental units, shortage of 7 million rental units right now in the United States. Now, that was qualified as relatively affordable rental units.
What do they mean when they say 7 million are short? Is that how do they come up with that number?
Yeah, that's a good question. It's probably I'm assuming that number is coming from the Harvard Joint Center of Housing Studies that puts together a report of how much demand there is and what kind of deficit. And again, the other side of the argument is people will say is, we have plenty of housing. We have enough houses for every single person in the United States. Yeah. This could apply to other types of real estate also, but it's not that we don't necessarily have the right number of houses. It's we don't have the right type of housing to match the demand. So true. Yeah, because it's like right now, like what's being built, it's the $400,000 to $600,000 homes, but we need starter homes.
Yeah, that was one of the reports here actually specifically mentions that because commodities prices are so high, materials prices are so high, it doesn't make sense to build the cheap homes anymore. They can't make a buck on that.
It's just a little bit more expensive to make one a little bit bigger, a little bit nicer, and same thing with apartments. It's going to take the same amount of money to lay the foundation, get the labor there, but then it's like, well, we could just spend marginally more on making the finishes a little bit nicer and make significantly more in rents. Why wouldn't you do that? Because there's a demand at the higher end as well. Just a couple of notes that I found was interesting. Wages are growing. They're growing quickly. They're not growing at the same rate as inflation. The largest quartile of growth though is in the bottom quartile. Which is good, and it's very favorable to apartment rents because where we would see the most pressure and kind of demand destruction is kind of at that bottom quartile, because if someone's only making X, you can only raise rent so much until what someone can pay. And
I didn't know that. I thought it was going to be a top heavy recovery, and then people that can remote work are doing better, and their wages. But that's
actually
that's
recent,
really good to hear.
I was actually just hearing that the kind of the top quartile isn't growing as much, and in fact, maybe even slightly declined recently.
Okay.
Yeah. So, but I think people switching jobs kind of in that middle bands, but especially the bottom quartile makes sense because it's the fast food, it's the warehouse jobs that are all of a sudden needing to pay people $15.
Yeah,
I saw that Target was going to be paying some entry level employees $24 an hour.
I saw that too. I did some math calculations. I think that's like $50,000 a year almost.
Yeah, and that can't be for like someone who's just checking somebody out like a cashier.
Yeah,
I don't know. But in the article it said entry level, but just those types of examples, and we're seeing it, with all these, Amazon facilities, all types of warehouses, logistics, really paying up, whether that's in the trades, construction industry. Yeah. People are being paid more, and so that kind of that bottom quartile, which if you are a kind of a multifamily investor targeting workforce housing, you're kind of right in the sweet spot.
Yeah.
Because we can really kind of see B plus class assets are set to perform, very well. Now there's still demand at the top end for the A class stuff also. But really, I think we're going to continue to see more and more demand. From the really in the workforce housing.
Yeah, that's
segment.
Really interesting. So, and the link between job growth, not just wage growth, but job growth and housing demand is something that we'll get into too. That I've kind of noticed, and it's really interesting how things are moving.
Well, let's just get into the report. There's an article from Barry Riddles from Riddles Wealth Management. I thought was pretty appropriate for the times we are in. And Matt and I, consciously said, there's no real reason to talk a whole lot about, the Russia, Ukraine. We're talking about multifamily apartments, some that's like hyper local, but it creates so much uncertainty, and everyone's talking about it. And I thought that this was a good piece to kind of ground us all and to give us a little bit of perspective. Yeah. Sorry, go ahead.
No, you just going in and trying to get news specifically on our, specifically multifamily news, but really like any business news, everything you hear is Ukraine. Yeah. It is dominating everything, and it's hard. It's hard to avoid it. But I think what I liked about this is there is a value to not looking past it, but to also recognize that this war is happening in a context in which people are still going to work today. People are still doing things. Markets are still moving. Yeah. So
markets are still moving. I mean, it's critical to pay attention to just because it is such a macroeconomic event. Talking about supply, we talk about supply all the time. Money flows, central bank activity. It's going to be, there are going to be ripple effects. A lot of those seem to be continuing to drive inflation though. But then kind of at the end of the day, I'm like, all right, so how is, a conflict in Ukraine going to affect the demand for someone needing to rent an apartment in the United States?
Probably and I also want to, an important caveat is just because we are talking about the things that are not necessarily the war and troop movements, it doesn't mean that we're trying to lessen or trivialize the devastation. It is a devastating war.
That's not what the folks. You can go anywhere to get that information. So let's just take a look at this. I thought so. Really, what Barry Ritholtz was looking at, he references back to 9/11. In the wake of 9/11, it's an emotional time, and one way that he used to cope was going back and look at all the geopolitical events that have taken place, really since World War II, to see how that affected.
He had his office was at 9/11. He just wasn't in there.
I didn't realize that.
Yeah.
Oh, he was at the World Trade Center.
This guy was in the thick of it.
Seriously, yeah. And so, so here's an interesting chart. Really going back, all these like major kind of political events, and everything from Pearl Harbor to the Korean War, the Kennedy assassination. And really the conclusion is, sure, there can be some noise and some short-term uncertainty, but at the end of the day, the correlation between these major geopolitical events is relatively muted and minor if you have any sort of long-term horizon.
Yeah, I think the quote that he said, it says, most of the time, markets are hardly affected by these sort of terrible events. Even the U.S. entry into World War II after the Pearl Harbor attack took a little more than 1 year to recovery. The worst war in human history, and markets were higher in 307 days.
Yeah.
I do, and I think this is the real point too. Is he says the lesson is to never bet against human ingenuity, creativity, or progress.
Yeah,
there are things, and this is what I was going to say. There are things that are happening now. The fact that people are going to work, the fact that people are still continuing, that's what's going to lift us out of this. That's what enables recovery. If everything stopped and everyone paid attention only to the crisis, then there would be no way to get out of the crisis.
Yeah.
So we need people to think forward, and we need people to keep building.
Well, and also what happens in a war, production goes way up.
Yeah.
You start building things, spending more money on things. You can often justify spending money in a way that you couldn't have done.
Yeah.
I mean, just when we kind of got out of a war with COVID, we've talked about how the current economy was kind of looking like a post-war economy. All of a sudden, maybe we're in an actual war, not directly.
I didn't think about that when I was reading this. I was like, wait, we talked about post-war. It's good to be post-war, not in the war, but that is a good point, though. People are doing stuff. There's a lot of activity that's happening during
I mean, the biggest, the effects are, supply chain, bottlenecks, and which can cause inflation and just disruptions. But then, like in World War II, which we're not going to see, we lost our labor force, sent them off to fight in a war. That's not going to happen this time, or obviously knock on wood, but we're still producing more. And just countries around the world are going to be spending more on defense and elsewhere.
Yeah.
The other effect is this going to, coming back to the Federal Reserve, how much shade is this going to throw on the idea of more interest rate increases? Jerome Powell said they are certainly going to be making, most likely, they're going to be raising the Fed funds rate at the next committee meeting. But how much? There's been all kinds of speculation, anywhere from 3, 5, 7, 10 rate hikes this year. But now with this uncertainty, it gives the Federal Reserve a little bit of cover to say, maybe we don't need to raise rates as much. We want to keep this thing cooking hotter to really get wages moving.
Okay.
And because what he said in his press conference today, their main goal is to make sure this expansion is a long expansion. It's not a short-term, growth and we go into another recession. And like we've discussed in the past, there's the risk of raising rates too quickly and throwing the economy into a recession may be far greater than letting inflation run a little bit hotter for longer.
Yeah, I think that makes sense.
And so let's, we're talking macro. Let's get back to multifamily. Where this relates to multifamily is rent growth historically always has outpaced inflation. And if we see continued inflationary pressures, haven't even talked about, energy and other materials related to energy. And, petroleum goes up. I mean, that's a lot of goods.
That's what I was thinking. Because if they're trying to hold back on rate increases, but then this war has an inflationary impact on the economy, then that makes it that's a double whammy.
Yeah. So I think all of this, as horrible as the situation is, I think actually could bode well for multifamily apartment investors.
Yeah, I also think that it is worth noting, like you noted earlier when you were talking about Jay Powell's and the increase of the kind of the lower income wage increases, is that when we're seeing inflation is not going to uniformly happen. And it looks like right now that multifamily is poised to kind of ride this wave early and to capture the beginning signs of inflation as it happens, rather than kind of getting on the tail end and not really realizing that.
Well, and there's one other thing going back to what Noah Stone from Berkadia was saying when we interviewed him, is that even though individuals' purchasing power may be decreased and kind of a real wage loss, the psychology of people not fully feeling that, because that's like a hard thing to quantify, because you're not looking at one price, but you do know if your paycheck has been increased. That's like a direct feeling of, all right, I've got a little bit more money in my pocket. It may buy me less, but it's harder to figure that out. So there's like this weird psychological delay.
Well, it's like the gradual increases are a lot harder to notice, but then if it's one big lump,
it's like the boiling frogs. They're not going to feel it. And what I've the Chipotle Burrito Index I found this to be interesting. In discussion of, is there inelastic demand related to burritos? Because are people just going to pay for, whatever because they need their Chipotle burrito once a week or whatever your frequency is.
Yeah.
But the price of burrito, it's like $15 now.
Yeah.
I mean, I got a burrito, some chips, and like a water recently, and it was like $21.
Yeah. That's
like lunch used to cost if you like a nice lunch, you're going to go out, quick, $10. It's that should do. You should be able to get a nice lunch. Now it's like 20. I mean, that's double.
Yeah, that's crazy.
Probably not the best use of money.
Boiling frogs, things will heat up, but for a little bit, it's like a spa in there. It's real comfortable.
Yeah, that's true. Yeah, it feels good.
Have to keep it
feels
just
kind of nice.
Up. Well, it's a little sweet spot.
A little bit of a jacuzzi.
And yeah, just a final note, just to return back to this article about about these global crises. I think it is worth keeping in mind that you can't rule out the possibility that a war on this scale could do lasting damage to the world economy. I mean, just saying it out loud, it seems obvious that there's going to be economic damages during wartime. But I think that the point of this is, again, like gradual improvements are taking place. And if you don't keep your eyes open, then you're not going to see these opportunities as they appear. And you're not going to be able to kind of help realize this recovery.
I think that's a really good point. And I think it encourages people to try to filter through the noise and not be so reactive. Because, I'll get people will ask me, well, how is this going to affect multifamily? And a lot of risk factors in the economy related to multifamily. And when we look at it, not necessarily just in a vacuum of, well, how will multifamily do, but how will all investments do, what various asset classes do. And multifamily, because of the illiquid nature of not being traded all the time, you can kind of ignore all of this, the noise and the volatility and the uncertainty, because it's like, we're going to hold steadfast, keep these things going.
Well, it's almost like a daily news show or, a 24/7 news program versus like a nightly news or a weekly news.
Exactly.
It's like, you're going to find out what the important things are if you don't have that.
Well, exactly. And sometimes what you don't know is fine. Like in the pandemic, we've said this, like, well, if we were doing a mark-to-market every single day on our property valuations, there were days, early in March 2020 where I'm like, oh, we'll look on paper, we've lost a lot of money because I don't know if there's a buyer, because there's no buyers in the market right now.
Yeah.
People throwing out crazy, distressed pricing, but there was no price discovery, so those transactions never occurred, so there was no market at that point. And so we kind of just skipped over all of that uncertainty investor psychology.
Yeah.
But it's like, so how will a full-scale nuclear war affect the multifamily investing industry? And it's like, well, people still need a place to live. I don't know what to tell you, but the stock market's not going to be doing that great.
It's important to realize sometimes you don't know, and to act. And almost, when you're dealing with multi-million-dollar properties, it's almost important to know when not to act and when to realize, okay, I'm going to have to spend some time and think about this rather than being forced to act on something that you may be speculating on overly. So.
Yeah, good point. All right, let's get into this Berkadia report, Matt. We're talking about permits and starts. Multifamily builders growing housing supply. Matt, what's the skinny from Berkadia?
Yeah, so I know this is a hackneyed segue, but we're talking about these constant improvements taking place, and this is one of these constant improvements that are taking place. If you look at the commodities prices and the high materials prices and the labor shortages, you might be paralyzed by the crisis. But throughout this pandemic, even in 2020, and of course, in 2021, builders have continued to build, and they're still doing stuff. They're figuring out ways to make it work.
Yep.
May not be perfect, but they certainly are doing it. And this is the proof is in the pudding here. They're really saying multifamily development is ramping up to fill the housing shortage. They're solving this problem. Both there is this Berkadia report, and there's a report from RealPage. They're kind of paired. They use Berkadia uses RealPage data. I think that what the Berkadia piece does specifically is it points to a couple of inflection points when it comes to multifamily starts and permits. There was a pre-2014, there was a little bit more apartments as a share of total housing. And then after 2014, the apartment development kind of decreased a little bit. And I think that there's another inflection point. If you look at this graph, the apartment building has started to ramp up since 2020, since really January of 2020.
Or at least the permits have. It seems like, we're looking at a graph for folks listening on the podcast. Annual multifamily, which includes units of 5 or more, permits and starts, and the permits are really kind of matching an all-time high. Like Matt, you said, just after 2014, really kind of peaking in 2015, where that kind of growth really leveled off. But yeah, no, it's right now. The permits at least are up to 700,000 units. But notably, the starts though are still down just above 500,000 units. And the question is, well, you can get permits, but when can you actually get started? So Matt, are you seeing that people certainly are building, but is it enough soon enough? And 500,000 is great, but according to Maxine Waters and Harvard Joint Center for Housing Studies, we need 7 million.
Yeah.
So we're making a dent, we're making progress.
Yeah.
And again, relating back to some previous reports that we've spoken about and reported on, a lot of the supply is only going to take place in a handful of markets. New York, the big markets, New York and Los Angeles, but then the Sun Belt, the Atlantas, Houstons, and Austins, they're going to see the bulk of this supply, leaving a lot of markets out that still need it. So from a national level, we're making some progress. On a local level, yes and no. Some markets, there's discussion of a potential oversupply in in Austin or Phoenix or Houston.
Yeah.
Other markets like Indianapolis, Kansas City, Midwestern markets, still not seeing the incoming supply.
Yeah, I it does make me think about, if they really are talking about housing in Congress, if they throw a bunch of subsidies at that, what that's going to do to supply.
Well, and they tried. I mean, Build Back Better had a huge housing component of really increasing availability of low income housing tax credits. Light tech housing development. None of that passed. And with Republicans, most people thinking they're going to at least take over the House, if not the Senate, and very little in terms of fiscal policy is going to be achieved in at least the next year or two. And even Jerome Powell even noted that, and going back to his testimony today, saying that specifically noting that a wind down in fiscal policy from Congress is going to attribute to kind of a slowing growth, because we're not going to see so much additional spending. So Congress can talk about it all they want, but the political realities are probably not going to get much in terms of additional. Yeah. Now, because they can't spend any money, can't allocate it anymore.
Yeah.
So,
I also thought, back to the Berkadia report.
Yeah.
They talked about why there are these inflection points.
Okay.
And just providing a little bit of context in the story of why there was so much building one time and so less building the other, and part of it is in the wake of the Great Financial Crisis and the housing crisis. It says there was a dampening effect on the single family market because of the housing bubble. So that's why from 2009 to 2014, there's a little bit more apartments being built. But then after that, there was a little bit more. There was a little bit less, so that it kind of bounced back.
Yeah.
In terms of more single-family homes being built after 2014.
And we don't have a graph to overlay, but just knowing kind of rental growth rates over the last decade or so, we saw rent growth really peaking in that 2014, 2015 timeline. And then it kind of really leveled off after that. So kind of really correlated to starts.
Now, aside from that little inflection point that we kind of identified in 2020, what I think is interesting here is the difference between what's driving people now to not really buy a house. They're not buying it because it's too expensive. Before, from 2009 to 2014, they were not buying a house maybe because they didn't want to be underwater. But now it's the elevated prices that are making people not buy. So it's completely categorically different than before. It's one thing to not buy it, because you don't want to. But if you can't, then that's...
there's a little bit of that because, they tightened lending standards.
Okay, yeah.
So it was harder to get a mortgage, but if you could, you still could. And but the price was right. So a lot of people should have been able to qualify, assuming they had a decent job. But now people have a decent job and they want to, but they can't because they don't have the down payment, or I mean, just hearing stories about people going through the home buying process, it sounds horrible.
Oh yeah. You're overbidding almost by default. And this is what I talked about earlier when we were just earlier in the podcast. There aren't enough single family starter homes to get started.
Yeah.
Because they're building the expensive homes, and then that just adds another barrier. It makes it so much harder to get over that and to get into the single family market. And so it just does seem like it's overdetermined that people are going to be renting for a while. There's a lot of factors that
and that's on the margins that really moves the needle in terms of occupancy and demand, because all of a sudden there's a big group that it was anticipated they would be buying homes, and like a lot of millennials settling down, but just it's not an option. Even if you can't afford it, it's like, do you want to go through the process?
Yeah.
And people saying maybe renting is just even a better financial option, and say, okay, I can't buy my own home. Why wrap up the bulk of my net worth and my largest investment? Why does that have to be correlated to where I want to live?
Yeah.
And so I'll rent, and I'll take that down payment, and I'll invest it in the stock market, invested in the Gray Fund, graycapitalllc.com/Gray Fund, open for accredited investors only. But whatever it may be, you make the argument that you should be, and most financial advisors would say, and this is financial advice, but don't view your home as an investment.
Yeah.
It's the place you live that may go up in value.
Yeah.
But don't count on it.
Yeah, that's another thing too. It's like, that we're not having the discussion of like housing as a right or whatever. Like, that's just not the way our economy is set up. But I think that has happened post housing crisis, is that people kind of have started to realize, okay, I don't need to own a home. I just need to live there.
Yeah.
So, and you can get a pretty nice pretty nice single family rental.
Oh, 100%.
So,
especially with the build for rent kind of movement really kind of picking up steam. And if you have a decent income, the new apartments are being built. I mean, like, it makes me, every time we tour one of these like newly built assets, it makes me think, I'm like, this would be pretty nice. Like, I think about it, I'm like, all right, should we just sell our house and move into an apartment?
And we also talked about this last week. There's like a pride of ownership, not a pride of rentership, but you are proud of where you live. You can still have that identity that's locked into where you live and your surroundings. You can still take care of. You can still, if you have a single family rental, keep a yard. It's just,
you're
the
not
banks,
saddled by
what's on the books is different.
And you're not saddled with a huge liability,
Yeah.
At the same time. And between, the bank, you've got a mortgage and, property taxes, how much do you really own? And, in China, it's like you can't even really own real estate. It's all, basically leasing it from the state. And like, while we don't say that today, we say we've, property rights and private property, have fun with your property rights when you don't pay your property taxes because government, is going to take it from you.
Yeah.
So, all right. So that, let's get into the real page. So, and again, this is similar data, but it's a slightly different take. I would say, multifamily continues to fill the housing shortage, which is, Matt, what you were just getting to.
They pull out a couple different data points here. Again, they're probably working from the same full set of data. I do think one of the things that it does is it has some specific numbers on how much the balance between single family housing and multifamily housing has changed. It was 80% single family before the housing bubble. And then from 2012 to 2019, this is that first inflection point. It was 65. And then now, at the end of 2020, it's 72% single family to multifamily. So it's come down. There are more apartments being built now than there are single family homes, but it's not at its height, not back to where it used to be. I think that, again, if we've got this huge barrier and it's not necessarily a thing about preference or anything, then we're going to continue to see more multifamily development. I think that it is interesting. They may have the numbers in this report. It's cheaper to build an apartment unit than it is to build a single family home on the whole. So
100%. Yeah.
If we're looking for a most cost effective way to create housing for people, then it would totally make sense to build more.
And just in general, the prices have risen to a point for apartments in general where, the materials have gone up, labor's tough, but the prices of the assets themselves have also risen. And, the problem that we're seeing is, replacement costs. No one's really sure what total replacement costs are. The cost to build an apartment unit, the cost to build an apartment complex. because things are moving just so quickly and changing. We don't know. And on the acquisition side, when we're looking at, stabilized properties or existing, you always want to buy under replacement cost, because it's like outside of the fact that they're throwing off cash flow, which has incredible value, just that is what the value is based off of. But if you're paying more than it could cost to build and it's not brand new, there's something not necessarily right about that, but we're not sure exactly where that line is of what would it cost to build this again. But I know a handful of groups that are jumping either into development or back into development who have been out of it for a while.
Really?
And they're
That's
starting to build again. So you've got the tool set. There are areas where there's a ton of demand, like we've talked about, that just aren't seeing the growth. Now there's markets with an avalanche of demand, but there's also an avalanche of supply coming, and what's going to outtake the other. Again, I'm thinking of kind of the Houstons, the Phoenixes, and the Austins, which are probably going to continue to do great, but it's just that extra risk factor that you just need to watch out for.
Yeah, that really, I didn't really even think of that. Someone, maybe it's a syndicator, or maybe, I don't know what kind of group that is that's going back into development, but it would be a persuasive reason if I'm trying to bid an apartment. It's so competitive, and it's like, you know what? I don't want to do this anymore. I'm just going to build my own. I don't have to compete with you. I'll just build it.
We've seen some properties that are not necessarily brand new, kind of 90s, mid 2000s, and the prices are above what we thought was replacement cost a year or 2 years ago. And so again, that really makes you pause. And that's one of the reasons we haven't pursued, at least this year, where we were last year and the year before. We're not necessarily going after like the brand new stuff, because it's sometimes going for a premium beyond what makes sense. And people are just trying to place capital, and they're just looking for value, and something that's brand new, shiny, great location should be a good investment over time. But if you're looking for cash flow and yield, it doesn't check all the boxes anymore. Where last year and the year before, we could find some of those newer Class A assets that you just need some operational value add to get at the cash flow. But now, just the opportunity, at least I believe, has moved elsewhere. Now, you probably get the kick from appreciation, but again, that's just a little bit more speculating than getting strong in place cash flow out of the gate, which is what we like to see.
Yeah, there's risks on both sides, I guess.
Sure.
But man, if you're, it could get so competitive, it's like, I'm willing to take that risk and build if you can.
The big risk is either undershooting or overshooting growth projections right now, and the margins are so wide. Like the standard deviation is so big, because instead of seeing 3 to 5% rent growth on a given year, now it's like 3 to 17 or 3 to 30. And so where's that going to, where are you going to lie in that huge spread? Because again, if it's 3 to 5, okay, well, if you assume it's 5 and it's 4, well, you've overshot by a percentage point. But if you assume it's 15 and it's 7, that's significantly, that's a much larger margin. So,
wow. Well, if you're talking about rents.
Anything else on the real page report, Matt, that
not
really
necessarily.
kind of
No, they have some of the frequent flyers, so to speak, the top markets, Phoenix and Tampa and stuff. They're building more units. 9 of the top 10 multifamily permitting markets increased their annual totals from the year before in 2021.
Let's just look at that. Just real quickly, just to remind some of the viewers and listeners who maybe somehow missed out on a previous Gray Report episode. And we covered this a little bit, but New York, White Plains, New York, they've got 34,000. So that makes, again, New York City, it's a big market. This, Philly, Camden, so it's 25,000, but that's kind of the whole, that Eastern Seaboard, mega metropolis, I think. But still, there's a lot of supply. It's a 223%.
Yeah, that's
And I'll just go back. So in New York, there's 34,000 units that are permitted. In kind of the Philly, Camden, Wilmington, they're including 5 states here: Pennsylvania, New Jersey, Delaware, and Maryland. 25,000 units. But then just in Austin, I think, again, so those are huge markets. Millions of people. Austin is a decent sized market, but it's permitting 24,000 new units. That's a lot. 24,000 apartment units is a lot. Then Dallas has permitted 19,000 apartment units. And again, Dallas is a bigger metro than Austin and is growing really fast too. But again, I think Austin's numbers are incredible. Behind that, in the number 5 spot is Seattle, 17,000 units. Then Houston, in the number 6 spot, 16,000 units have been permitted in 2022. Then we've got Denver coming in at 15,000. Then Phoenix at 15,000 as well. Nashville following Phoenix at about just under 15,000. And then the Washington, Arlington, Alexandria market, MSA, is at 13,000. So as you said, a lot of kind of what you would expect.
What you noted, and this is something I'd like some perspective on, and I'll have to do some reading, is what is the normal number of permitting? What's a normal number of absorption? How does it relate to the size of the metro? So 35,000 is big for maybe Austin, or Phoenix, but may not be so big for New York.
Well, it's all relative, and I bet New York's it probably is within kind of like the average, I'd imagine, and it's all relative to demand too, because if demand wasn't as strong a couple of years ago, you can justify. But the metric that we look at is pipeline, construction or permitting compared to the percentage of existing inventory, and that's a better kind of metric because 20,000 in one market is a drop in a buck. In a New York market is very different from 20,000 units in a market like Austin. Even though Austin's a big market, it's not New York City. And so looking at the percentage of inventory growth over time, that's something we should definitely take a look at. Obviously, then you have to relate it to demand and demand increases. But
because I mean, on the one hand too, it's like you're looking at these; they seem kind of small, like 20,000 for a population of millions. I guess, but actually these are significant numbers, and they're actually probably going to have an effect on the market. And it represents some real serious gambles. Not gambles, but some serious development.
Call them what they are. I mean, you obviously educated.
That's investment.
Educated speculation. But I mean, we're outside of this trend line. I mean, again, we're looking at a graph, back at multifamily starts and permits. The permits have really spiked up outside of the trend line. I mean, again, 700,000 units in 2022 permitted, only around 500,000 expected to be delivered. I mean, that's up from, kind of the past 5 years or so. We've been, at least on the permit, and permits are always, looks like a little bit heavier than the actual starts, with the pandemic being the exception. But we've been in the kind of around 300,000 in terms of starts. Now permits, though, I mean, kind of have been around, anywhere between 400,000 or so, really kind of mid 400,000 over the last 5 years. It'll be interesting, just the pace of deliveries. I think that's going to be a major driver.
The pace, and then I also am curious how many permits don't pan out. How many times are they permitting something and then the project never gets completed? That's
a good question. I bet it's relatively rare, but that's a good question to quantify, because I mean, there's a lot of costs associated, but a lot of deals, it's permitted, but doesn't. I don't know. Yeah, that'd be a good question. I haven't seen that statistic reported. Note.
Got to get a developer in here and interview him.
Yeah, might as well. All right, Matt. So NAR. You want to get into this NAR report?
If we could talk a little bit about the apartment list one really quick. I don't know if you want to.
Forgive me, because that is one I wanted to discuss. Just went to the wrong page in the show notes. And again, if you guys like this information, not only should you be subscribed to the Gray Capital YouTube channel, so you'll be able to watch all of these, all the Gray reports. But you also should make sure you are subscribed or downloading the podcast as well, so you can watch in the car. But GrayCapitalLLC.com, we've got a nice blog over there where we're doing a good summary. We're actually going to do even more in-depth summaries of these, right?
That's right. They're coming up.
They're coming up. And then GrayReport.com, really everything you need to know to stay up on top of the multifamily industry. That would be GrayReport.com. And subscribe to it all. We'd love to leave us a comment. We'd love to have a conversation with you. But so, apartment list, Matt.
Yeah.
This was a again, apartments list numbers are always a little bit different.
Yeah.
Compared to some of the other metrics. I think they usually report rent growth is a little bit hotter than like
totally.
than some others. So I think that's just a good caveat to note.
Still some trends that you can see, and you can look at the movement maybe rather than the absolute number. The headline on this one is that rent growth is normalizing, still growing, but normalizing, and vacancy is at 4.5% after inching up from a low point of 3.8 vacancy last August. I don't think we're headed towards a vacancy doomsday. And if this trend continues, so it's gone up 0.1. Vacancy has ticked up 0.1% every month to get to now. If it keeps ticking up at this current rate, it'll take 15 months to get back to the pre-pandemic normal of 6%.
Yeah.
So I don't think that we're in... and the way that they phrase it actually is that the market's eased up a little bit for renters. It's not tight on for the renter side, and that's when we're talking about rent growth all the time. I'm also thinking in the back of my mind, well, you want renters to be able to afford it. You want renters to be able to get an apartment too.
Yeah.
So it's good news for them. And also I don't think it's definitely not alarming vacancy. It's just I think normalizing.
No, I mean let's just go back and compare to 2018 and 2019. So we're looking at a chart here, month over month change in national rent index. So again, this is national numbers, so take that for what it's worth. But just going back to 2018 and 2019, and we're really highlighting the seasonality and the natural cycles of the apartment industry. In 2018 and 2019, in January, both Januaries, we saw a rental decline, as well as in December. Really, September, October, November, December. In January, we saw rental declines in 2018 and 2019, but that was preceded, or at least the later in the year declines were preceded by stronger rent growth. So still, nominal net growth for 2018 and 2019, but this cycle, the seasonal cycle, makes a lot of sense. Everyone wants to get leased up and moved in prior to August, before school starts, before it starts getting cold. And this happens every year. So kind of August is the last really good, strong month. Usually June and July are always the peak months. And if we fast forward to 2021, I mean, the July number is just massive. But that is almost always the peak.
Yeah, it seems like renter season is March through July, those 6 months. February, it looks like it builds up, but it's not quite the perfect peak. March through July is when people are.
Yeah, March is really where it begins, and then July it starts. That's the last month, and then it starts tapering off after August. August is the last month, but comparing, because we've seen a lot of articles recently being like, oh, rent growth is slowing, or rents decline.
Oh yeah, I looked at the data tables that they have for this since 2017. Usually, rent growth is month. This is month to month.
Yeah.
Is 0.3% for February, and now we're at 0.6. Small number, but that's still twice the average.
That's double.
Yeah.
Exactly. So, I mean, back in 2018, so in 2018, there was a slight rent growth in February, but 2019, there was some rent growth also. But to your point, Matt, we're seeing stronger rent growth in February, almost double than what we would previously have seen. So there's really not much data to show that there's data to show that there's an evolution to being more normal, but there's not a whole lot of evidence to show that growth is going away. We're seeing declines. It's just the rate of growth is slightly decreasing.
We talked about this almost like a month ago about, I was talking about momentum. And I think that this is really what it is. It's not a snapping back or like a correction back to normal. It is a momentum, kind of a normalization rather than, we're correcting. It was too high before, so now we got to go low. Now it was too high. There's still value there, and the growth's still going to increase, just not at the rate that it was.
And again, this is on top of all of the rent growth that we saw last year, really start of the pandemic. And I keep talking about this, but it needs to be mentioned because I don't see it being written about. Is just the difference between the market rent and the effective rents, in the fact that the market rents grow 1 year, but that doesn't get absorbed for another 1 to 3 years. And so, like when I'm having conversations with investors, one consistent theme right now is talking about growth and looking at some of our assumptions, being like, well, it looks like you guys have plugged in some relatively strong rent growth for the first year or two. Rents have already grown so much. How are you going to just think things are going to continue to grow? And what we have to explain is what we're modeling in is not future growth, future rent growth that we're talking about right now that's already happening. We're just talking about absorbing the growth that happened last year.
Yeah, getting the people
and
that already
all
live there.
of the people who already live there eventually, not even at market, just closer to market. Now, if there is an additional growth, which there already is, we've already seen it's already happened this month. So it's it's less than it was in 2021, but it's not even half. So maybe we don't get the 15 to 20% rent growth. We get closer to 7 to 10 or more. Yeah. That's still like triple a normal year of rent growth.
Yeah.
And again, that's new organic rent growth that then has to be absorbed. So then we're really looking at kind of 5 to 6 year, call it 5 years or so of really strong, just organic
and that makes
growth
sense.
in general. Yeah. Okay, Matt, last report on the Great Report, NAR, National Association of Realtors, Commercial Real Estate Report, February 2022. What's the skinny?
Okay, so and I'll just go over this briefly a little bit, but we cover this once a month whenever it comes along. I don't think that I think that what I like about it is it gives a good perspective on multifamily's performance compared to other sectors of real estate. The story really hasn't changed very much since last month, but what I did want to pull out for this one and is that they give a little bit of a context, especially like an economic context behind some things, and they pulled out some numbers for job growth that I thought was particularly interesting. Now we were talking about this earlier, and so I think it really jives with our earlier discussion. What they're saying is that the tight labor market may be a barrier for further economic expansion and further commercial real estate expansion. I don't think this is an alarming development. I think a tight labor market is
well. You're going to build a warehouse. You got to have people to work at the warehouse or
and
whatever.
That's true, but I'd rather have a tight labor market than high unemployment. I think what it really should do then is motivate a look into the markets where job growth is stronger. And then because I think you said this specifically. It's like a healthy job market is going to mean a draw for the population to a specific area.
100%.
Yeah. NAR actually has a list of the top markets for job growth, and reading this list I think is particularly instructive. Again, we always see the frequent flyers, the Phoenixes, and the Tampas and stuff, but this list is interesting. I like to look for stuff that for markets that aren't really present, what are the standouts and
which markets are trending that maybe not everyone is paying attention to? So
if you're you see these job things and then you're looking at rent growth and then you're like, well, maybe there's an opportunity for rents to grow. You're not seeing it in the rent growth, but maybe in the future.
And so you're really looking at this as a leading indicator.
Yes.
Yeah. Crystal ball, as they say.
That's and these are the rumors that you buy on. Maybe the news is one thing, but
there you go, exactly.
So one thing that really stuck out to me is at number, I think it was number 7 on this list or number 8, Kansas City. It's a Midwestern market. Now, on the top of the list is Salt Lake City, Tampa,
Provo, Jacksonville, San Antonio, Nashville, Atlanta, and then Kansas City.
You got Kansas City, and it's doing well. So let's say easily in the top markets for job growth. But then if you look at the apartment list report, it is one of the lowest when it comes to rent growth.
Salt Lake City?
Yeah, Salt Lake City. It's like number 4 for slowest rent growth over 1 million. So for cities over 1 million residents, it is the number 4 slowest growing rent growth in the past year.
We'll have to look at what kind of supplies come online. What if that's affected. But Salt Lake City's been doing pretty well. I remember in the middle of the pandemic.
Kansas City?
Sorry, Salt Lake City.
I was talking about Kansas City.
Oh, Kansas City. Sorry. Okay.
Growth,
so Kansas City employment growth but moderately low rent growth. So forecasting potentially we're going to see some continued rent growth in Kansas City over the next couple of years.
Now, Salt Lake City is another, a whole nother bit. I've heard so many stories of the jobs and the people that are coming in there. It's really like a boom town.
It really is.
Especially the speed of it.
Yeah. I think it was one of the only major markets in the United States that did not experience net job losses during the pandemic.
Wow.
Yeah.
They're like the mountains.
Let's look at some of these, the job losses too. Just while we're on, the topic of job gains, we're talking about jobs. Maybe some of the markets you may want to think twice before you make an investment. New York, New Jersey, kind of the New York MSA, they've got top of the list, as you can imagine, which also the top of the list of construction, which is always interesting. Yeah. But minus 500,000 jobs.
And we didn't get a chance to talk about this when we were talking about the apartment list report. But Minneapolis, I was looking at some of the markets with the slowest rent growth. And I was saying, like, what is the story? Why do they have slow rent growth? Now, San Francisco, San Jose, that's one. Mm-hmm. That's explainable. It's already high. Seattle was another one, already high.
Yeah.
Washington,
and you got the tech jobs, people moving out. Mm-hmm. And
DC was another one already, very high price.
Yeah.
Midland and Odessa, Texas were the next one. And that's like fluctuation with the oil industry.
Okay.
But then Minneapolis was this outlier. I was like, what is it? Why is it has such slow rent growth? And if you look at the highest net job losses, they're in this list, and they lost, where is that? They lost
73,000.
Now, relative to population, I think that's huge.
I agree. And then the other thing that Minneapolis has not going for it. So just job loss in general, which obviously relates to not seeing strong growth. We covered this when we were looking at the eviction moratorium.
Yeah.
Minneapolis was one of the strictest in terms of not allowing evictions to take place and really running that market with an iron fist and being overly friendly to tenants and very adversarial to landlords, which does not create a positive environment. And then also on top of it, had all the riots and the police, and that rubbed a lot of people in Minneapolis the wrong way. And I think a lot of people left, and it's cold.
Yeah, I think it's the cold thing. That is honestly the number one thing. I was like, wow, this is like this cold suburb. Maybe like that in Chicago. I also think Minneapolis it ranks up there on the best places to live.
Yeah,
I think that, and I was looking up articles, and the vacancy there
it's been a good market to invest in previous years,
and the vacancy is actually relatively low too. I think that it could just be, that's restrictive policies are kind of really putting a damper on rent growth in the area.
Well, we put together a video last year in 2021 where we connected the dots between markets that had more restrictive policies on housing in terms of being less landlord friendly and their poor performance as a real estate investment market versus markets that allowed market activity to actually function. You can enforce property rights and contracts and that were a little bit more, I would say, balanced and still leaning towards residents and tenants. I mean, even in Indianapolis, which is very landlord friendly, a lot of judges still are like, there's a pandemic going on, let's give people a break.
Yeah.
But still, comparing the markets that just had more of an actual functioning market, those markets significantly outperformed markets that were very restrictive. So Midwest and Sun Belt, beyond, there's other migratory and trends pushing those markets forward, but big difference between landlord-friendly markets and tenant-friendly markets.
Yeah, I think there's a lot of factors that go into rent growth. I think job is one of them. I think that the government policy is another. I did want to note really quick on that same list, you got Indianapolis as a second Midwestern city on there. It's at number 13.
Yep, just under 12,000 jobs coming online.
It's doing great.
Job gains.
We're talking about job growth driving rent growth. I think that there's a lot of potential there.
And so just on that topic, man, because we talk about this a lot of demand versus supply. In some markets that's seeing strong demand but strong supply, and other markets that are seeing strong demand but just little supply. Looking at Indianapolis, which is one of the markets that has the least amount of supply coming online in the country for like a major market, there have been more job gains in the last year in Indy than there were in Denver, which there are 20 some thousand or 15 to 20,000 units coming online, and in Indianapolis there were 2,300 units that came online over the same period.
And I would bet that the jobs that are coming online are jobs that are for like renters.
Mm-hmm.
And if we're talking about
100%,
if that has any connection with wage growth. But I do think that Indianapolis is a burgeoning logistics powerhouse, really.
It is. And it's that bottom quartile of renters that we talked about. And I'm glad you kind of kept us on this, Matt, because I think what also is interesting to look at, because all this is relative to size, so right? So this is a list, just kind of net total. And but what are some of the markets that are punching above their weight class in terms of gains? And then some of the markets that are really not doing what you would think. I think Salt Lake is in Provo, Utah, that are all near the top. Those are good to highlight. They're both doing over 20,000, have gained 20,000 jobs over the last year. But another one is Elkhart, Goshen, Indiana.
Oh, yeah.
Which, not exactly a major market.
When it comes to proportional to...
I think it might be just based on population and current jobs. But, I mean, they have 9,500 jobs growing. Now, we know about those drivers as we have an asset right outside. It's in South Bend, but it's right down the street from Elkhart, RV capital of the world.
Oh, yeah.
Baby boomers, millennials, everyone's getting into the van life, RV lifestyle, going into the national parks, not slowing down anytime soon, even the pandemic has, obviously slowing down. I
forget if it was you or someone else that yes, there's RV construction there, but they're slowly building out like a larger.
It's a lot of other stuff too.
Yeah,
and it's RV. It's all kind of recreational boats, and but then they've been diversifying into other like different types of manufacturing also. Because in the past, the criticism of Elkhart in particular is that it was so concentrated into one industry. Is that during the during the 2008 recession, Great Financial Crisis. The job losses were massive. I mean, and the unemployment rate was like near the top in the country because who was buying RVs in 2008? Yeah. Everyone was being foreclosed upon. You weren't going out and buying an RV. Now, fast forward, no one's being foreclosed on, and all the baby boomers have, bigger nest eggs than they ever thought they would. And they're retiring. And why not buy a boat or an RV or something? So you need a lot of people to put all that stuff together. I'm just trying to think, again, Utah's got a handful. There's St. George, Utah. I'm just looking for any others. Raleigh, we've talked about Raleigh a lot. Lakeland, Winter Haven, Florida. I think that's kind of central Florida, 12,000 jobs coming online. That's quite a bit. We mentioned Kansas City.
Fayetteville seems, that can't be too big, but 12,000, 13,000 jobs.
Yeah, Fayetteville.
Sorry.
So that would be the headquarters of Walmart.
Okay, all right, that makes
sense. But it's still, obviously it's like a couple different like metros, but still a lot for relatively small MSA. We know a developer that's targeted that market pretty tactically because of that. It's kind of off the radar.
Yeah. That's interesting.
But look at that growth. They were pretty smart because they got into there a couple of years ago. Fascinating stuff. All right, Matt, what else on this NAR report? They always have a lot of good stuff. Any other asset classes to touch on? Any other...
I think it is probably worth looking a little bit at industrial, the industrial section, and we can kind of look at the general performance and the vacancies and how it compares to multifamily.
And then maybe we'll go back to multifamily just to kind of put a nice bookend.
Yeah, well, we can talk. We can talk about multifamily.
Let's stay on multifamily. Yeah. Okay, well, let's look at some of these takeaways. Because one thing I think is interesting, they're looking at different types of the different classes of multifamily, how they are comparing. Let's just take a look, get to the raw data. First, though, net absorption is outpacing net deliveries. We've talked about that quite a bit. Usually they're pretty correlated, but wow, look at how that absorption is just outstripped supply. Now that's going to normalize, and I'm waiting to. There's so many factors that cause that, but it's still hard to wrap my head around the fact that there was that much absorption over such a short period of time. And I don't know if it's housing and affordability in terms of like an actual single family home. People just are forced to rent. They sold their house. They wanted to buy. They couldn't find anything. They're renting a house, or sorry, they're building a house. They're renovating a house, but they have to live. They have to rent somewhere in the meantime. I mean, I know a lot of people like that, and so I think a lot of it's short term. The incredible amount of demand and absorption. I think it's going to stay elevated because people still aren't going to be able to buy a home.
Yeah,
but I don't. That needs to come down because that's just almost unsustainable.
Yeah, I come back to absorption measures the people that are moving in to otherwise vacant units, but doesn't necessarily completely represent every single person that wants to rent.
It's not interest. It's actual like leases.
Yeah. So, worst case scenario, there will no new people after this 575,000 absorption. Then there's going to be no one. But
everybody's got a place to live.
Yeah, I don't think that's the case, but it does illustrate the fact that like this doesn't. It's not like a survey was listed out. It's like, do you want an apartment? But yeah,
Matt, can you break us down the percent distribution, the 12-month net absorption of multifamily units broken down by class A, B, and C? Because I think again we can talk to broad and general demand, but getting a little more granular. I'm asking you because I can't tell the difference between the colors. So
yeah, the class A is actually leading the pack here, and with like 51.98% distribution of absorption, and then followed by class B at 37, and then class C at 10.88. I'm not really sure what the traditional difference between the absorption is. But that is a story that we've noticed is lifestyle. Lifestyle renters have been doing very well. At the beginning of the pandemic, it was like workforce housing was doing particularly well. But then now lifestyle, it seems to be doing well. Actually, though, I've seen a lot of charts that have absorption really pinched. All of them are really, really tight markets. So I don't know. Some of this,
I think absorption is high. I think they're just there's just been there's a decent amount that was delivered. People moved in.
Yeah.
And I also think that, like we just talked about, I'm buying a house, I'm renovating a house, I need a place to live. And in general, people have more savings. They're spending a little bit more money. Like I was talking to somebody yesterday, he's going to Disney World, and everyone getting the fast pass no longer has an advantage because everyone is buying the fast pass.
Yeah.
And so it's like, the fast pass line is just as long as the regular line because everybody's got a little bit more money. Yeah. And if you have just a little bit more money and you're looking at a couple different apartments, maybe you will spend an extra $100 or $200 a month.
Oh yeah.
Especially with rents have risen everywhere, so it's like, okay, I could spend $1,000 on this, 1970s built apartment that's been renovated, but it's it's not brand new.
Yeah.
Or I'd move into something that's built in the last couple of years. Very fancy. Everything's new. Everything's nice. Best amenities.
You want the nice stuff, of course.
Who doesn't? And then if you're like, hey, I can buy a home, but I don't want to go through the process. Yeah. I'm just gonna rent something nice and wait it out, see what happens. So I think that all kind of makes sense. And also, I think it also gets to the point of the transitory migration that's been going on, people moving around to different so you moved out of New York, you moved out of Los Angeles, you moved out of San Francisco, you moved to an Austin or wherever, but maybe you're not going to buy right away. Some people did. Some people are buying stuff, sight unseen, but if you can't find anything or you don't know where you want to move, like I'm new to this town, I don't want to necessarily buy something when I don't know which neighborhood I want to be in. So I'm going to rent for a year and see what it's like.
Yeah.
So I think that Class A high absorption is probably going to continue, but it's going to moderate because I think a lot of those shifts,
that makes sense.
A lot of those decisions have been made, and a lot of that stuff has already happened.
Yeah.
So, multifamily units under construction. We really talked about this previously. And again, just the year-over-year percent change in asking rent. They're breaking it down by class, though. Across the board, according to NAR, there's been 11.1% increase. Again, that's different from the apartment list report that had it like 17%.
Yeah.
Class A is leading the way at 12.7, Class B 12.1, and Class C 8.1. So Class C has been lagging, but again, these reports of so much wage growth in the bottom quartile would mean that it looks like Class C may have a little bit room to grow.
For sure.
This may relate to the fact that just wages aren't growing, to inflation, and these renters are more price sensitive, and you just can't get the rent increases where there's just been more headroom in the A and B class sectors to move rents a little bit and really track inflation. But it'll be interesting to see if we get much more parity, if C catches up, or if we just see continued growth.
Class C, does that represent affordable housing? Or is that a completely different category that's not?
Usually this is market rate.
Okay.
Usually it's just taking the market rate and not subsidized housing, but I don't see that they've necessarily if it's CoStar data, it would be market rate because they could be including some affordable.
Okay. I'm just wondering because
that's a good question.
If we are talking about potential government action and they're using that language, they're using affordable housing. So I wonder if anything happens, if that effect will be maybe felt in Class C, or maybe it's relegated to specific affordable housing.
That is a good point. 33% of metros have double-digit apartment asking rent growth as of February 26th. Another list, a lot of familiar familiar names on this list. Breaking it down by markets of different population. Matt, there's not enough time to cover all these different markets.
Yeah.
But if you hop on over to grayreport.com, you'll be able to find this report, assuming that you're hopping on around the date that this comes out because we update it every day. But the best way to really, outside of checking grayreport.com every day, if you sign up for the newsletter at graycapitalllc.com/newsletter, we're just going to send you these reports directly to your inbox every Thursday. That's really the way to go, and that's the way most people are consuming this type of information. There's really not a service like Gray Report out there, Matt. Yeah. So really trailblazing. Apartment units under construction as of 2021 Q4 amongst metros with at least 250,000. Again, we've touched on this in the previous reports. It's not a big, change. But what they do have on here, which we have touched on in the past, but not in today's report, is the percentage of units as a percentage of inventory, which brings things into context a little bit more. And they also have market cap rates, which their market cap rates look a little bit more accurate compared to like a CoStar's, which are just, almost worthless. So, as a percentage of inventory in New York City, 3.8, which again, so 500,000 job losses, still building, quite a few units. But some of the ones that stand out that you want to be watching to make sure that they're just not getting over their skis. That would be the first one coming to mind would be in Austin, Texas. Again, a ton of demand, 20% year-over-year rent growth, incredible. But 10% of units that are coming online as percentage of inventory or under construction as of 2021 Q4. Next one I would be watching out for would be Nashville, 12.7. That's maybe a little bit more concerning because you're seeing strong demand, but not Austin demand. But they're building more as a percentage of their existing inventory. Miami at 9%, Orlando at 8%. Not as concerning. Tampa 5.2. To me, that's a sign that, like, compared to I would rather be going into Tampa than Nashville, most likely. If with just looking at the construction as a percentage of existing inventory. In Minneapolis, 5.3%. Minneapolis is having a lot of problems.
Yeah. 3.6 rent growth. That's the lowest on this chart.
Yeah, that's pretty bad.
And they're still they're still pumping out new supply.
Yeah, and it's not on this list, which I'm glad so no one can figure it out unless they're listening to the Gray Report. But Indianapolis is like the percentage of inventory. I think it's like 2% or so.
Wow.
Construction percentage as compared to a percent of current inventory. So, it's got the pipeline like a Los Angeles, but the growth like I don't even know how to compare it to. It's kind of growth on its own. More linear growth, not exponential, but still growing nonetheless. All right, Matt, do you want to just move on to industrial, or is there anything else on the multifamily side that's worth...
I'm good with multifamily.
Yeah, let's just... So office... So the office, to down the report, read about office. It looks like it's at least hit its bottom and is recovering. That's great to see, but that's not necessarily the focus. Industrial demand, net absorption as of February 2022. We're seeing a lot of industrial activity, especially in some of the markets that us at Gray Capital are watching. It's a lot of demand. Now, Q4, it dropped off. I don't know if looks like that may be like a seasonal thing in general. Q4, things kind of slow down. Q4, Q4. So that makes sense. But wow, 2019 is really starting in Q2 of 2020. Man, that is a lot of absorption. Peaked at 160 million square feet of national absorption. That's a lot.
Yeah, the burning question that I have is whether the growth in the industrial market during the pandemic is going to continue. There was a lot of talk about, the economy of things versus the service economy, and is that shift back to the service economy really going to help or hurt? It seems like it might hurt the industrial market, but if we're investing a lot into logistics and warehouses, then I think that could sustain. I mean, e-commerce.
Let me ask you this: so, you just personally, you and Liz,
yeah.
How much stuff are you guys like buying on Amazon, grocery delivery? Like how much? Yeah. Are you buying? How much more e-commerce are you participating in?
I definitely haven't dialed it back.
Yeah,
and that's my like on the face of it, if you're talking about a pandemic, this shift but like my personal sense of it is that I don't think that people are going to change their habits too much coming out of the
But did we shift? How much did we shift our habits or accelerate the shift during the pandemic? I guess is the question.
Yeah,
because we were ordering stuff on Amazon, obviously before the pandemic, like everybody was. We were doing a little bit of grocery delivery, but not really. We had like one service that was like every other week that sends some produce.
Yeah, I think the trend's pretty sticky.
But like we're doing a lot of grocery delivery. We're doing we get a lot of our household basics just from Amazon now, because Amazon Prime and it's free shipping. And now our neighbors are like, you guys get a lot of stuff shipped to your house, but it's like, yeah, because we don't have to. It's free to ship it and get a bunch of shampoo and whatever it is, just getting shipped straight to our house.
Yeah.
One less trip that we have to make. I don't see that slowing down, and I think that there are more people who have yet to adopt doing that, and that's going to continue to grow. And e-commerce and the need for logistics and warehouses was already growing significantly, and then it's all of a sudden just the demand has just really popped in this industrial development.
Yeah,
is kind of trying to match it.
It doesn't seem like it's going anywhere. Logistics is the industry of making things go somewhere, but I think it's here to stay.
Yeah,
when it comes to demand,
I think so. So the best way to keep track of all this stuff, Matt. Obviously, we've got GrayReport.com, we've got the YouTube channel, the podcast, the newsletter. Though, I think is the best way. I think it's the most digestible. GrayCapitalLLC.com/newsletter. You're going to get all these reports plus more, plus analysis. It's really curated content. I think it's essential reading once a week. Again, every Thursday, 8:30 Eastern, GrayCapitalLLC.com/newsletter. But make sure you subscribe to the Gray Capital YouTube channel as well. That way, these videos, if you're watching on YouTube, it's going to pop up as soon as we release them. And on the YouTube channel, we're doing other types of content also, more education focused, showing what we're doing at Gray Capital and the Gray Fund. But then, of course, it's available as a podcast wherever you'd like to get your podcasts. And if you are someone who's looking to make an allocation to multifamily real estate in 2022, trying to take advantage of all this growth that we're seeing, the opportunity that we clearly see at Gray Capital, if you are an accredited investor, I'd encourage you to check out the Gray Fund, GrayCapitalLLC.com/Gray Fund. It's a $100 million equity fund. We're going to be going out and buying about $300 million worth of cash flowing multifamily assets, primarily in the Midwest. Heard us talk about Indianapolis a lot. That's what we're from. We know the Indy market better than just about anyone in the space. It's a big target of ours, but we're also going after other growing markets throughout the Midwest. We talked about Kansas City, handful of other really strong markets that we really like. Very strong pipeline. Check us out, GrayCapitalLLC.com/Gray Fund. Only open to accredited investors only. This is not an offer to invest. Any big plans this week, Matt? What are you doing?
No, rest and relaxation.
The weather is looking better.
Yeah.
It's supposed to be 69 degrees on Saturday. I'm just
Yikes.
fishing.
Wow.
If I can get away.
Man, the fish wake up after the winter.
Oh, yeah.
All
Ready to go. They're hungry.
Okay, yeah, that's
They're
right.
moving. I've
Yeah.
seen like little green shoots, popping out of the ground. Things are happening.
You know that 2 weeks from now it's gonna blizzard.
Oh, I know.
That's
Yeah.
Indiana.
Yeah, it's March. We get excited. We're like, oh, a little bit of warmth. And then, then like a snowstorm comes and April is like just dreary. And we're like,
I'll take it where I can get it, though. That's true.
Exactly. So hope everyone is enjoying their time out there, taking advantage of it, the good weather that you may or may not be seeing. We'll catch you next week on The Gray Report.